Hi traders, Barry Burns here with Top Dog Trading, and today I'm going to share with you one of my favorite Japanese candlestick charting techniques. In fact, I'd actually say this is my number one favorite Japanese candlestick charting technique. So it's pretty simple. Nothing totally new, but I do want to share some details about it because the dollars are in the details. So a lot of people learn the general techniques of various things, moving averages, candlesticks in this case, other indicators, but it's really the details that determines whether you make money or lose money. So here's the concept for today. This is the bar I'm looking at right here. Whoops, I caught two bars. Okay, actually, let's open our scaling up here so it's even more clear. So the concept is this. On this bar, let me see if I can nail that better. There we go. Good job, Barry. Anyway, so that's it. Now, here's the key element, is that we want a long wick on the top, and then at the bottom, a very narrow real body. Now, I don't care if it's green or red, and this is detail number one. When you have a wide, by the way, it needs to be a wide range candlestick from the high to the low. If this basic pattern here, which is a longer wick on top and a small real body on the bottom, if that's a narrow range bar from high to low, then this pattern does not matter. It's null and void. So that's one detail. So step one, got to be a long or a wide range bar from low to high. And what do I mean by that? How do I measure that? I measure that in relative length of the bars before it. So most of these bars, as you could see here, these bars are not as wide range in this zone here, and then all of a sudden we get a real wide range bar. So that's step one of the detail. Step two of the detail is that, again, and this part isn't the detail, this is the meta pattern, is that we need a, I would say the real body at most should be in the lower third of the bar. If you want to be even more conservative with it, the lower 25% of the bar. So, and now again, this could be green. I wouldn't care if it was green. In other words, if it's green, it means it closed below the open. And some people put, and this is one of the dangers of candlesticks actually, is that people get enamored with whether the bar is green or red. And in certain situations that matters, in other situations it doesn't. And the one where it doesn't is when the real body is very narrow range from the open to the close. And the reason, the market logic, what we're talking about here today is market logic. In other words, we're not just using patterns that were taught in, books created in the 1940s or, for goodness sake, hundreds of years ago in Japan by rice traders trading rice down in a van down by the river. A little Chris Farley reference there. But, that was before algos and high-frequency trading and quants. My goodness, it was before computers. So markets have changed a lot. They move very differently now than they did hundreds of years ago in Japan. So we got to get real about this. And so when I talk about market logic, what I'm saying is, what does this mean about what's happening in the bid and ask auction place in the world internationally? So for example, this is the E-minis. So they're traded internationally by people in all different countries, different brokerage firms, they'll be using different time frames. They'll be having different data speeds. So what that means is there's going to be a little bit of noise. A little bit of noise to the market. You cannot expect that your patterns, your lines, your trend lines, your moving averages, your candlestick patterns in this case, are going to go to the exact penny, pip, or tick, or, God forbid, pixel on your chart where you think they should. Now, there's going to be a little bit of fluctuation there because of that's what the real market is. Bid, ask, auction place, and there's a little bit of noise. So when you got a real narrow real body, I don't give a mouse's left, or for that matter, right patootie, if it's green or red. That just, we got to accommodate the noise. All right, in this case it's red, so that's fine. But what I'm really concerned about is this long wick up here where the real body is in the lower 1/3 or 1/4 of the bar. Okay, so what does that mean now? What's the market logic behind that? What does that mean in the auction place? What that means is that the market participants, the traders, during this period of time, whatever period of time this is, by the way, that this applies to all time frames. I would say, sure, it probably applies best to daily charts, weekly charts, monthly charts, but it still is a meaningful signal on any time frame. And the meaning is that during this period of time, during that one bar, the market, the people trading the auction place, they said, you know what, we've tried to make trades up here, and we just couldn't, see if I can get that there for you, yellow highlighter. We couldn't get any traction up here. We couldn't get buyers. Not many buyers up here. People didn't want to buy. No. And so the market valued this particular financial instrument at these lower prices, and they rejected these values up here. They rejected these prices up here from that price. You can see the prices up there to that price. These prices were rejected by the traders, saying, no, that's too expensive. We don't value the market at that. We ain't buying up there. And that's called rejection of value. Now, that term rejection of value comes from the, and this is another really important point, by the way. So market profile is where that term comes from. Now, when you can cross two different theories in market technical analysis, and they align, they merge, and they're based on two different approaches to the market, that's pretty awesome. That gives you a higher probability trade for several reasons. Number one, that logic is sound. Number two, you've got different people from different theories all trading that pattern, and therefore self-fulfilling prophecy that different people trading different theories, different approaches, techniques, strategies are going to be on that trade. And that's what makes the market move. Imbalance of supply demand. So we need more people with, pushing in the supply and not that many people buying with demand. And that makes the market go down. Now, in this case, we've got a trend. And this is what I like. So that's the other thing. We can't trade just this candlestick by itself. That, no bueno. No bueno. That and a $20 bill will get me a homeopathic amount of caffeine at Starbucks. That's how much that one candlestick pattern is worth, which is not a lot. So we've got to take it in the context of everything on the chart. I never trade any one indicator, any one candlestick, any one moving average by itself. We need a preponderance of the evidence. And so almost like making a legal case. So I'm looking for what I do in my system, the Top Dog Trading System. We look for 5 uncorrelated variables of money flow. Money flow is that imbalance of supply demand. Look at an approach from 5 different angles that are each uncorrelated to each other, and when they all align, that's when you've got a high probability trade. So this would be just one of the 5 pieces of evidence. Now we're in a downtrend. That would be a second piece of evidence. Okay, we've got a cycle high. That would be a third piece of evidence. So, and then you can add momentum to this, support resistance, and we're off to the races. All right, but that is a super high probability cycle high in a downtrend. Put all that together. So I'm going to do part 2 on this. I'll show you how I use it with reversal trades. This is how I use it with trend trades, but I also do the same thing with reversal trades. But again, there's a little different rules for that, a little different nuances. So that'll be part 2 of this series. So, hey, I'll tell you what. I mentioned my 5 energy methodology. So what I'll do is I'll give you access to that. I've got a video. Actually, it used to be a live webinar, and I recorded it now, so you can watch it at your leisure. Just go to indicatorwebinar.com, and what I'll do there is I'll share with you how I set up the cycle indicator down here, and that'll be the primary focus, but I'll also give you the concepts of my 5 energy methodology, all for free.